Let's broaden out the implications of whether or not that even comes to fruition, but the idea of it a little bit more here, given the knee-jerk reaction we saw yesterday as the S&P 500 fell about 1% after we got that report. And for more on that, I want to bring on Cheryl Smith, Trillium asset management economist and portfolio manager, joins us now. Cheryl, good to be chatting with you here. I mean, we saw that knee-jerk reaction. It's always interesting to see investors react to news like that. That's not final, of course, but just a proposal, an idea out here. But what did you make of that, and maybe what it would mean for the market if we were, in fact, to see something close to it come through?
Thank you. It's a pleasure to be here. So I think it was indeed an instinctive reaction, kind of the lizard brain fear. Oh no, taxes, what are we going to do? But it really is important to take that into context and to think about what those tax revenue is going to be used for, and also to place it in historical context. So in terms of what it's being used for, the investments in childhood education, community colleges, and so forth are, while they are long-term investments, are investments that would lead to a much more productive workforce, with studies indicating that early dollars invested in early childhood education return $4 to $9 for every dollar spent. Of course, that's over a long period of time. So the effects that it would have on productivity should still be extensive and something for business to look forward to. The second element is to look back at what capital gains taxes have been and to realize that this level of capital gains tax is going back to what we had in the 1980s. In the 1980s, we moved to a really different way of looking at it, and a move toward taxing unearned income, that is capital gains and dividends, at a much lower rate than we tax earned income. And that really has led to a skyrocketing in income and wealth inequality in the United States. So this is really returning us back to an earlier philosophy.
So Cheryl, it sounds like you think the benefits outweigh any sort of negatives that could come along with this. But we got this note from Goldman Sachs saying that they believe that the number is certainly not going to be as high as has been floated out in the press. They believe it's going to be anywhere close to 28%. From a market perspective, what do you think will be the impact?
First, of course, we have to understand that we don't know what the number is going to be until we get to that final number. There's a lot of opportunity to adjust that. I expect that what we will see is at least an attempt by the government or Democrats to get the unearned income tax rate similar to the earned income tax rate, which would really reverse those decades of policy. In terms of the market, I think, bearing in mind this effect of higher productivity, we have been stalled in a low productivity environment for the past 25, 30 years. And so I think that this could be very positive, but we are also starting at a valuation that's relatively high, even in the context of an economy that is growing quite rapidly right now. So I think that we're likely to see some bumps, but we are quite positive and quite constructive on what this would mean for markets and the economy overall.
Yeah, Cheryl, when we look at markets overall, stepping back and just factoring in earnings season and where we're at with that, more than a fifth companies reporting about 81% beating, and yet don't really get the sense that a lot of those beating get rewarded with huge pops these days. And I know obviously expectations are pretty high, but what does that say to you about where we go from here moving forward, what it's going to look like for these companies reporting, left to report, and where you put kind of the enthusiasm in the market right now?
Sure. What we think happens, again, you need to put things in context. And we think that with the coronavirus pandemic, it became very difficult to estimate what companies were going to do. And so the market, in a sense, in 2020, turned to 2021 earnings as kind of the measure. And so we saw price earnings ratios and valuation rise dramatically through 2020, accounting for almost all of the returns in 2020. So what we think is going to happen this year is we will see those earnings kind of justify those retrospective price earnings ratios. So the fact that companies are not being rewarded with a giant pop is an indication indeed that earnings expectations are high, but we also think that what we will see over the remainder of the year is that earnings continue to improve as we continue to see restoration of growth in the economy, and we will see a market moving up. It's unlikely to be up quite as much as it was in 2020 because it's easier to get a market increase on the back of that PE. So we're anticipating seeing price earnings ratios remaining pretty constant through the year. But bear in mind that earnings are expected to go up 37% this year, 2021, and that those earnings estimates are being revised on a weekly basis in the upward direction. So we're still quite positive and still quite constructive on the market.